Hello, my friends. Hope you guys are enjoying well and our market is booming like anything. It's skyrocket currently, right? It's more than 20,000. It's crazy right now. But as we are follower of mindfulness, you need to be very careful in at this point of time. So don't be hurry, don't rush on anything, don't take decisions right now. Be calm. We always start our investment when the market is down at least minimum 5%. That is how we have to plan our investments. Don't rush and dump your money when the market is going up. Currently the market is going to touch the resistance, and the market seems the volume is not that great. It's again, be careful when you are doing the trading or anything. So just be cautious. Okay, this market can be, I don't think it's that our market is currently that much strong to break the high and go further up. So be cautious. That's my guidance. Okay, coming back to our video. So today what I'm going to do is I'm going to show you some guidance. To already in the last video I demonstrated how to pick mutual funds, right? So now in this video, using mutual funds, how to do a proper asset allocations and build your portfolio and wealth with minimum of 30% of your salary. This is Sundar and you are watching Mindful Finance. Okay, see, as I made already a video about asset allocation and other things, but just to repeat, asset allocation is very important throughout your horizon. Okay, the initial age when you start your investment journey very early, during the time you can be more aggressive and you can take challenges. Again, it's up to you. It's not always that everybody has to take risk. It's not a thumb rule or something that if you are less age and you need to take risk, but it's just an assumption that assuming that your journey has more and that the younger age is the something that you can take risk. That's the whole concept. And when your age grows up, your aggressiveness, your risk parameter has to reduce. That is how you have to allocate your portfolio. Now, I'll just show this to you what I have made. So this Excel sheet shows an idea about my allocations. I'm assuming my age is 25. Whenever your age is less than 30, assume such a way that your asset allocation towards equity can be 80 to 90 percentage and debt can be 10 to 20 percentage. So that is how you have to think about your asset allocation percentage. So equity 90 percentage, debt is 10 percentage. Then for next 10 years you are in the same way. Then from 35th age you will be reducing your allocation, which is equity becomes 80 percentage and debt becomes 20 percentage. Then when you are in 45 age, your equity becomes 70 percentage and debt becomes 30 percentage. So that is an assumption we are going to take in this journey. And during this journey you'll understand what how can we allocate further in this one and what fund I have to pick. So let me show you that part. See, there are n number of mutual funds in the market, right? Index fund, hybrid fund, debt fund. So a lot of funds are there. Now, okay, I mentioned equity for equity as a 90%, but when I say equity, which fund I have to select, right? That's where our challenges are, right? So what we can do is we can pick Nifty fund, Nifty index, which is a Nifty 50 or top 50 stocks, which has all 50 stocks, right? That is the one part of equity. Then you have Flexi cap. Flexi cap is something that the fund managers can align the percentage whatever way they want. Like sometimes they can align 40 percentage to the large cap, sometimes they assign 60 percentage to the large cap, whatever it is, right? I'm just giving a number, but randomly they can change the ratios for large cap, mid cap, and small cap. Ultimately, they will invest in all type of caps, like that's called flexi cap. The other one is a multi cap. Multi cap is something that very interesting. They'll invest in all three, like large, medium, and small. But the point here is it has to be equally allocated. For example, it needs to have like 20, 20, 20 kind of a thing, or 30, 30, 30, like 26, 25, 20, something like that. It's always this allocation will be equal. There won't be anything more than the other one. It will be more, but slightly bit more, but not in a very with a large gap between the caps. right? That is the multi-cap. Flexi cap, multi-cap, this is the difference. And you understood Nifty 50. One more is there called Sensex fund, which is Sensex invest. I'll show a sample, okay? Let me first go step by step. Let me show the Nifty 50. This is our Nifty 50. If I take a Nifty 50, say UTI, okay, let's say UTI. See, if we go to UTI, see, large cap is 89%, mid cap is 11.3%. It is a pure Nifty 50 index, right? But why they are investing in 11.3% in mid cap? That is where the problem comes. I don't want to have this kind of a complexity. I have something in my mind. I need to follow the fund has to align to my thought process, what I'm thinking. Let me check the Flexi cap. Okay. See, let's say Parag Parikh. Parag Parikh is one of my favorite fund, which I'm already invested on that. But it's up to you. I'm not a SEBI registered advisor, so I cannot suggest or recommend a certain thing. But it's been a long time. It's performing very good. But right now in this video, I'm not going to advise a Flexi cap. First, I'm just giving a heads up for this one. Okay. If I see Flexi cap, what is happening is, see, if you see the rank also is the top one. Okay. If you see, large cap 71%, mid cap 6.2, small cap 7.4. I don't want small cap and mid cap, boss. Right? That is my thing. This kind of allocation I don't want, because 71.9% again you are investing in large cap, and again you have two different things. I don't want this kind of a one. So purely what I'll do is I'll go for like Sensex plan. You can select, there are multiple Sensex are there. You can pick whichever you want. So I'm, for demo purpose, I'm showing the Nippon India Sensex plan. If you see distribution, 100% large cap, nothing else, only large cap, pure large cap. This is what, even if you go for large cap fund, right, they will have some percentage in different things. That is why I don't interested in other funds. So large cap 100%, and if you see what are the stocks, 30 stocks, only 30 stocks, which is mega cap. Nifty 50 is large cap, but within the 50 stocks company, you have 30 stocks, which is called mega stocks. So nothing else, pure large cap. This is what I want. Okay. And if you see the return, what it is giving, 14.3% in average. Okay. In last 5 years, it has given 14.3. So in average, you can expect large cap is something that 13 to 14% you can expect. If large cap, this particular Sensex is not performing good, that means our India cannot achieve our $5 trillion economy. Because our whole India is depending on this top companies. If they don't perform, then we cannot trust our market. That's the whole point, right? So we have to go with that kind of assumption. Our government is doing good, our economy is booming up, and we can expect a growth in our economy. So this is what I am planning to have, a Sensex mutual fund. Then comes to multi-cap. Let's come to multi-cap. Okay, there are a lot of multi-caps there, but I am a fan of quant active fund. I'll just show you the quant active fund. Okay, if you see quant active fund, it has given a return of 25%. In an average, a multi-cap can give you 20 to 25% in average. It's just these are based on past record. Okay, you can select any other multi-cap, but for demo purpose, I am taking this one. If you see as per IND money, this is the top one. Okay, if you see equity is 98%. So here also very clear that equity is 98%. Debt is 1.9, which is okay. 2%, it's okay. If you see the percentage of allocation, 26 in small cap, 20 in mid cap, 24 in large cap. Still we have large cap over here. Already we are having a investment in Sensex, which has a mega thing. But still this is a combination of all, and so that at least it is aligned to our plan. Okay. And if you go and check the holdings, equity holdings, 51 stocks, right? It also mostly will have our top stocks. Okay. But point is, they can change this one. They can, within the large cap, they can change whatever they want. But there it's a always top 30, right? Here, based on the performance, they can always go back and change the allocations. But overall, if you see, all three caps been assigned in a similar percentage. So now comes a debt fund. Okay, what to do with the debt? Where to invest? There are a lot of bonds are there. Okay, if we call debt, I normally prefer corp or money market, because the money market is something that it will invest in our treasury bills and other things. It will give at least, in an average, our treasury bonds have given a yield of 7%. So you can go for a money market thing, or corp bond. Corp bond is a little bit risky, but uh, is risky in the sense it's aggressive, but it gives a good return. Okay, it is showing a 4 to 5%, but in the long run, it may give more return than whatever it is mentioned. So you can pick anyone. But personally, I go for gold fund, because I made a video on this part. You can check my video, gold ETF, investing in gold ETF. So that may give you an average of 8 to 10%, actually speaking. Okay. So I personally believe gold fund, but I'm not forcing you to do that. You do your own analysis and find which one is best. Within, you can go and check within corp bond or money market. Okay, just check within this whichever you suits for you. Now let's come to our calculation sheet. So this is the calculation sheet, and this is purely based on your salary. Assume that my salary is 20,000. If I say my salary is 20,000, my age is 25, what I'm trying to do is I have to allocate 30% of my salary for investment purpose. You have to be very aggressive, guys. So if you are not aggressive, it's very tough. Aggressive in the sense you have to focus more on savings, investments. So if your salary is 20,000 and you have to you have to try to increase your salary. But within the salary, what you want to do is 30% is you get, without thinking anything, assign for investment. The remaining amount, you plan whatever you want, right? So 20,000, you will 6,000 is going to be our investment. So here, if you see what I have made is 90% is equity, right? Within 90%, what I'm trying to do is I am investing 30% in Sensex and 70% in multi-cap. This is my way of doing as allocations. Okay, how I want to go with, and the remaining 10% debt is 600 rupees. It could be gold or anything, right? So if we go for next 10 years, 35 to 45 age, next 10 years, what I have done is I have increased my investment by 20%. So initially it was 6,000. Now my SIP is going to be 7,200. So I'm assuming for 10 years your investment is going to be the same number. But actually you need to step up every year. You have to increase by 5%, but it's okay. But just for understanding purpose, I'm just giving this easy way to visualize. So for 10 years we are going to be same investment. Okay, then next 10 years we are going to invest 7,200, and next 10 years 8,640. If you see in the second 10 years, if you see, I have reduced. See, Sensex is 30%. I'm increasing my allocation towards mega cap to 50% and multi to 50%. Equal, now it's become equal. From 70 I have reduced to 50. From 30 I have increased to 50. And the next, if you see, Sensex 60% and multi is 40%. See, normally Sensex, why I'm trying to increase is Sensex, the top companies always, it's very, see, when it goes to high, right, it's already in a growth stage. It's already grown a lot, and giving a return of 12%, 13% every year is difficult for them, right? But in an average, they will try to manage to have a 13% or 14% CAGR in their company revenues. But assumption is those companies will stay stable and you will get a stable return. That is the assumption. Okay. And debt also I'm increasing from 20, see here 20%, then 30%, right? If we see, if I do the similar way, what is happening is the first 10 years, my return will be 17 lakhs, 17.75 lakhs. Then the average return of 23%. Okay. Next 10 years, if I invest in this way, my return would be, see, this is my total investment. Previously also, like I invested 6,48,000. This is my return. And here 6,91,000. My return is this much. And the next 10 years, my investment is 7 lakh, and I'm going to get 21.9 lakh. Got it? So the return also 20%. Since I'm allocating more towards debt, your return, your average rate will be reduced. Now, if you see, if I invest in such a way, at the age of 55, I'll be having 1 crore 46 lakh. Using this per month, I can have 85,000 as a interest. You can put in a FD or you can put in a bond or whatever it is, right? assuming this is a 7 to 8% of interest return. So every month you can get 85,000. The here point is, I assumed 20,000 across your all 30 years. That is my assumption, right? But in reality, it can increase. Just for example, I'll tell you, if I have a salary of 50,000, I will end up in having 3 crore 66 lakhs, and every month I can get 2 lakh 14,000, right? So that is the power of compounding, and that is how you have to plan your investment and allocations. Initial days, be aggressive, be more towards investment, then you can get retired earlier. If you step up in every month, every year, like the 50,000 salary may increase in next month, next year, you can increase your investment from 15,000 to 16,000. That way your retirement age can further reduce, so you can be financial freedom, and you can do whatever you want when whatever you want at early stage. You don't need to worry about your future, right? So that is what the whole concept here. So hope you understood this, and I have demoed some mutual fund also. Now you got idea about which mutual fund and how to allocate within your what is it, risk parameter. So I'm not a SEBI registered advisor, so I cannot tell you directly which fund to invest or what fund to invest. I can just guide you. So that's what my previous video was about. Purely it was about how to pick a good mutual fund based on your risk appetite. If you didn't watch that, please go back and watch. It's a very detailed video. View is very less on that video, but I made it in such a way that normal people can go and understand how to invest in a mutual fund. So that detail I have made it. So just do your things mindfully. And one more news, I'll share a link in this video that I have published a book. It's currently in a Kindle version. You can go and buy that book and grow your wealth mindfully. Thank you.